meetings every quarter with the committee members. I'll have them introduce themselves, starting with Ralph. Just your name and your position.
Ralph Clegg, Director of the Health Department.
Jim Tracy, Utah County Sheriff.
Dave Shawcroft, Utah County Attorney's Office.
Kim Jackson, Utah County Treasurer.
And then I'll have our guest from NFP and Prudential.
My name is Jeff Scott. I'm a Vice President at NFP.
Jared Benson, Vice President at NFP as well.
Hi, I'm Kelly Faraday, Vice President of Key Account Management for Prudential Retirement.
This meeting is being recorded and it will be available for view on our YouTube channel. Usually we follow an agenda that, now that I'm thinking about it, y'all don't have access to. So we typically review the meeting minutes from last time. So we'll have NFP go over our meeting minutes from last time, and then we will need a motion and a second in order to approve the meeting minutes.
So we're attempting to move the meeting minutes up now. We'll wait till they're up on the screen. Can the committee members see the meeting minutes on your screen? Can't? You have hard copies. We can just reference the meeting minutes from our last meeting. So the only ongoing and outstanding conversation from the last meeting that actually had no pending action item was moving from an investment menu that included revenue sharing to one without. That action item was postponed due to the RFP, and our understanding is it's postponed indefinitely until the beginning of the year. As a result, there were just 3 funds on a watch list. Otherwise, using the current revenue sharing model, that are there was no recommended change from the last meeting. So other than just regular notes to the meeting, there are no pending action items from the last meeting minutes.
Someone want to make a motion to accept the meeting minutes?
I think we need to get a copy and review them before we approve them. I'd move that we continue the minutes for the next meeting.
Okay. A motion and a second. All those in favor to postpone the meeting minutes till the next meeting, say aye.
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 That passes unanimously.
Okay, thank you. And if we can pull up the agenda for today's meeting quickly, I just want to review the agenda we've proposed. The first was to review the prior meeting minutes and any action items. The committee motion to postpone those. The next agenda item would be to have Prudential deliver their executive plan summary, and Kelly will do that. After that agenda item, we've got a quick plan diagnostic. We'll do a third quarter market review, along with a fiduciary investment review, including your investment policy statement review and how the investment menu is doing currently, as well as a legislative and a regulatory update that would be relevant to the county's plans. And we'll follow up last with some additional discussion, questions, and any outstanding action items. With that, I'll invite Kelly to deliver Prudential's executive plan summary.
Good afternoon, everyone. So what I'll do, we have the presentation up on the screen. So what I'll do is reference pages that I'll be talking about. And then Jared will go ahead and move those forward as we go. So we're going to go ahead and start on page 5. We'll take a look at the plan asset summary on page 5. We have 3 plans within the Utah County plan.
Hey, Kelly, just
Yes.
sorry. Can you, since we have people watching and they won't know 401k from 457 and we just have the numbers, can you just maybe explain that real quickly?
So we have 3 plans within the Prudential plan. We have a 401k, which is the first plan. We have a 401a, which is the third plan. And we have a 457 plan, which would be the middle plan. So what we do is look at what the plan assets were year over year from last year to this year. So the total plan assets were $136,841,703 in September of last year, and we closed the the quarter at 150,427,438. So there's been quite a significant growth within the plan. Let's remember that we had some great market growth this year. Guys, what are we up to? Are we pushing 20% this year? Year over year? Year over year, yep. And then if you just move down the page a little bit, Jared, we do like to also look at who's participating in which plans. So these numbers are, we have 258 participants that have balances in both the 401A and the 457. We have 352 participants with balances in both the 401K and the 401 or the 457. And then we have 255 participants with balances in all three plans. So about a third of the population is participating in one or more plans on the county. So we'll go ahead and move to page 16. This page really talks to us about year over year numbers, what the plan demographics of, this would be the 401K plan alone, what those plan demographics are year over year. So total participants in the plan last year was 1,206, and that amount has grown to 1,248. When we talk about total participants, that would include both active participants and terminated and suspended participants. And in those numbers, we have grown from 948 participants to 968 this year. And we still have 254 terminated participants. And for those, what that means to those in the gallery is that they are terminated, but they have chose to leave their dollars here at Utah County, which you certainly can do. So those participants have grown from 254 to 276. And then suspended participants are the same, 4. And what that is if you take out a hardship withdrawal, we, by law, must suspend your contributions to the plan for 6 months. And so those are how many people have taken out a hardship withdrawal out of the plan. Average participant balance within the plan has grown from 69,000 to 76,000. The median participant balance has grown from approximately 39,000 to 41,000. And then the participants in the plan that are 50 and over have grown from 507 to 509. So the total assets within the plan for ages 50 and over, it has grown from 50 million to a little over 56 million. In the next group there, we talk really about total contributions in. So year over year, we had $6.7 million of contributions, and this year we had almost $6 million of contributions. We had employer contributions in 2016 of 3.3 million, and this year we had 3.1 million, with employer contributions of 2.878 million, and then in 2017, 2.6 million. So we also had some rollovers in, which means you've taken dollars from other places that you may have worked and rolled them into the plan. That was much larger last year with almost $458,000, and then this year it was much lower at about $135,000. We also like to look at total distributions coming out of the plan. They were pretty steady from 5.2 and 16 million, with this year being 5.3 million. And the percentages are very close. 6.2% of the assets were distributed in 16, and 5.6% of the assets were distributed in 17. So you can see our total averages balance that we had talked about on the earlier page is sitting just over 95 million to end the quarter of 2017.
Kelly, question, do you have any idea why the contributions are lower this year than they were a prior year?
You had people pull their contributions down most likely, and we have a page that we're gonna reflect a little bit on where our contributions are sitting this year. So my guess would be that you had less people pull, so let's say that they automatically enrolled in at 6.2 and they took their contributions down, maybe to 4 or 3%, then of course, and then are you talking about the employer contributions?
Well, just overall, I would have anticipated them going up actually rather than going down, so it just surprised me a little bit that they're down across the board actually. And I'm not sure why. I would hope they would go up, because, you know, the emphasis is to save more for retirement rather than less, so
Right.
I'm just curious, and the total distributions seem to be about equal, so I was just curious as to why it was down.
Generally, when contributions go down from an employee contribution basis, because they've dropped their contribution rate to something lower than what either they're at and or when they were automatically enrolled, they chose to go in and make it less than what they're automatically enrolled at.
I wonder too if maybe some folks are retiring and they were contributing at a higher rate and maybe
See?
replaced by a younger worker that's maybe not contributing as much, that might have an impact.
Let me just look on one page here for you, Kim. Let's see. So this isn't year over year, but we had,
What page are you on?
I'm on page 20. If you look at page 20, there's asset allocation net activity by age, and if you go over from 45 to 65, you can see large amounts of rollouts, distributions.
Well, and remember from previous conversations that we've had where we have 150 million in assets, and then we have, I don't have the page up right now, but I think it was 56 million now are over the age of 50 versus, I think it was 50 million. We just looked at the page, so.
Right, so if you see what the participant balances are, from 45 to 65,
That's 51.
over $60 million.
So
Is
as we
in-
get a bigger chunk of change in that 50 and
Correct.
older, we're gonna have more rollouts.
Which also would bring down your average contribution rate, because if you had people that were over 10% and now they're leaving, it's gonna skew the number down a little bit, correct?
What you were saying with the less money.
Let's go back to page, this is, because I don't have a lot of time, I'm going to just talk briefly about, different features on the plan and some of the statistics of those features. And my pages are sticking together, bear with me. If you turn to page 17, this book really has a lot of information, and I'm sure Cammie can post this as well to a public site if you want more in-depth detail. We spend most of the time on the 401k plan because that is the plan that the match goes into. That is also the plan that holds the most assets. So what I'll do is I'll go over the other two plans very briefly, but for the sake of time, we'll look at page 17 and talk about the plan features, and then we'll just kind of look at some of the activity along those plan features. So we do have GoalMaker on the plan. GoalMaker is your asset allocation tool and it is also your qualified default investment election. What that means is it is a tool that asset allocates out by age and by risk tolerance, and we do monitor what those statistics are within there. So plan assets for participants in GoalMaker have gone up from 27 million to 34 million. The percentage of assets for GoalMaker participants went up from 33% to almost 36%. The number of participants in GoalMaker went up from 502 to 595. And then the participation rate went up from 41.6 to 47.7. So you're sitting right about the average for our book of business at Prudential, which is about 50%. And what's nice about that tool is it not only asset allocates for you by choosing conservative, moderate, or aggressive, it also rebalances for you. So if you have your money in different asset classes, and that class happens to do very well in a quarter, every quarter it's going to pull you back down to have that equal balance within your range between your age and your risk tolerance, so that you're not over allocated. The next feature that we have on the plan is Income Flex. Income Flex is a guaranteed income stream product that ties to Goalmaker, that allows you to basically ensure your balance within the plan. What that does then is it guarantees you an income stream for life for whatever portion of your balance that you put into Income Flex. Currently, we have 48.5% of assets invested in Income Flex. We have went down from 18 to 16 for participants, and we have only about 1.5% percent in 16 that was actually participating in it, down to 1.3. So that's not unusual, and it is particularly not unusual on a plan that also has the availability of a pension, because it does kind of look and act like a pension that you're using. However, I know that's something that the committee's talked about getting some more information and doing some more education on in 2018.
I have a question there. So we only have 16 participants, but half of the total balance is in Income Flex? That doesn't seem to
No,
correlate.
half of their balance.
Well, half of their
half
balance.
of their
Those who
balance.
participate. Oh, okay.
Yeah.
Thanks.
The participant.
That helps.
Yeah, sorry. We also have Roth on the plan, and the Roth has grown from $779,000 to over $1.2 million year over year. We have 101 participants, and it's grown to 126 participants. The participation rate in Roth went from 8.4 to 10.1, which means that that's growing. So I do know that we do outside work with NFP, as well as Dick Loomis and his his meetings with people. So that's telling me that we're talking about it and we're growing that as well.
You think that number's so low because it defaults to the 401k and not the Roth?
Well, yeah, and yes, I do think that. I also think that there's again education around what Roth can do for people, but also just know inside of a 401k plan, match is always put in tax deferred because the entity wants the tax deduction. So they would have to go out and move their own dollars over into Roth, because most companies don't want to forego that tax deduction they're allowed for the tax deferral.
It appears, though, that we're actually running a little bit higher than your average
Right.
in Prudential as
Mm-hmm.
far as being in the Roth. I'm not sure what that says about county employees, but
When I might want to credit that to the work of NFP and Dick Loomis, because I think that
They've
you
been
guys do
pushing
a
it.
lot of individual meetings and talk to people on an individual basis, which really does help people understand what's really good for them. So that's where I think some of this growth is coming from the work that they're doing.
Demographics play a large role as well, and if you're a 34-year-old living in New York, 60% of your income likely goes to
taxes.
housing, and then you're paying a high state income tax, and so,
Yeah.
and you're not married or have kids or mortgage, and so you're likely to go pre-tax in that environment. Whereas a 34-year-old here has 3 kids and a mortgage, and a low state income tax threshold, likely retire here, Roth is probably a better decision. So when you look at a 7.1, that includes people from demographics where Roth is not as beneficial to people.
So the one other chart I'm just going to briefly touch on is the one to the right, transaction summary. We can just talk about, if you want to slide that over, Jared, just a little bit. What our transaction Rs for how many people we had enrolled. We had 203 enrolled in the prior year, with 109 enrolled this year. We had contribution rate increased from 115 to 175, which is a good sign. But we also had contribution rate decreases from 100 to 137. So there's a little bit of the question answered. Total contribution rate changes. We had 215 last year and 312 this year. The number of participants with transfers, meaning they've done something inside of their plans, they're moving money around, that's what we consider a transfer. 925 people did that last year, and 645 people did that this year. We had last year we had 75 loan initiations and 74 this year, so that stays relatively steady, which is good. We had 618 distributions last year with 342 distributions this year. So that would also play maybe towards its lower amount of distributions, but maybe higher balances play into that as well.
And can I ask a question? The contribution rate change, we don't know if that's up or down. It's just a change.
Yeah. So, and speaking to that then, Cammie, we can turn to page 23, and we'll look a little bit with the contribution rate, because I know you have particular, with the whole Social Security offset and matching at 6.2%, you have a different, things to work around when it comes to contributions. So this breaks out our employer contributions by rate. Starts at 0, it's on page 23. Starts at 0, goes to over 10, 10 plus. The one thing you'll see on this chart is how many people are deferring at 6%, which is where we enroll everyone, right around 6%, 63.6%. And then you'll see you have 9.2% of people deferring over 10%. And then just a lot of different things in the middle. But what I'd like to point out on the bottom is we have 4.9% of participants have no employee contributions. So we do have just about 5% of the folks not collecting their 6.2% and not contributing. So that's something that we should, make sure that somebody reaches out to them and says, you're really missing your 6.2%. Then we have 9.7% of contributing participants that are not at the full match. So that's another place where we could do some work to make sure that everybody understands why their match is so important. But we do have 85.4% of participants that are contributing at the company match or more. So that's really what we want to see. We really want to see that most of the people in the plan are participating over what the match is. So that's a good number.
Do we have any demographic information on those two categories, the 4.9 and the 9.7?
We can get it.
I'm just wondering, is some of our temporary, are they allowed to get contributions
This
to
is the plan.
retirement?
This is the K.
For 401K, correct?
This is just the
This is
401K,
Okay.
57, so
All
time
right,
limited.
so this wouldn't include any time limited.
full-time.
Limited is the 7%.
So these
to
are full-time
457.
people that are actually foregoing
These are-
company match, which, there could be a lot of reasons for that, but
Kelly, do you know how many of the, how we compare with that 85.4% rate to other
Very good.
similar organizations?
It's very
That's
good.
high.
Yep.
I think one of the reasons it's high, though, is because it actually replaces Social Security. So you have a lot of people who realize that and want to participate, for sure.
Right.
I may jump in with a suggestion. There's one mechanism that the county could use called re-enrollment. We've talked about that in prior meetings, and the objective of re-enrollment is to push reset on enrollment and set as a default the 6.2%. So if it's the county's intent to replace Social Security, which this is because you opt out, it'd be one way to sweep all the non-participators back in up to that 6.2% rate. It's legal. It's used as a best practice today in retirement plans. Not necessarily plans that intend to replace Social Security, but as a mechanism to actually help those that would otherwise, if they were educated, knew they're missing out on this benefit, you could re-enroll them back to the 6.2%. And what you'd find, the research shows that when you re-enroll, most participants will stick with that default. And so what you get is you capture that 10 to 15%, who my guess would be that if they knew they were missing out, and understand that there is a windfall and elimination provision with Social Security, and this is your Social Security replacement, they would get back in.
So on the re-enrollment, you would advertise widely that this is the point in time that we're going to re-enroll you. Would they have the option to opt out?
Absolutely.
If they didn't want to be re-enrolled, but they'd have to take some action
Right.
to notify us
Correct.
if we decided to do that.
How soon would we need to make that decision? Is it too late to do that for this year, to start?
Anytime, you can make
Good
that
throughout the
decision
year.
anytime, yeah.
Yeah, we wouldn't be able to get it, from a record-keeping standpoint, we wouldn't be able to get it done by the end of the year.
That's what I thought.
But I really think we need to roll that by the commissioners as well.
Sure.
because it does have the same implications of what, like the contribution escalation we had last year, so we want to make sure that we would do a presentation to the commissioners to make sure they understood, you know, why a re-enrollment makes sense for, in this case, which I really do believe it does, so.
I think it's also, you've got individuals who maybe changed it for 1 or 2 pay periods and forgot to change it back.
Yeah.
So people
It
that
could
don't
be that
even
simple.
realize
Mhm.
they're not
Yeah.
contributing when they think they are.
Right, and they do, and I do know from attending the benefits fair, and you fellas as well, is that we do talk a lot about that to the people that come by, so that they understand that, you know, are you matching to 6.2%, and why you should be, and do you remember from when you enrolled? Because some people have been here 15, 20 years, and they don't remember that, oh gosh, I forgot we're not gonna get Social Security. So, you know, I wanna make sure that that's just something that we continue to talk about and make sure people are not leaving money on the table.
And then, you mentioned windfall elimination, if you could just give a brief, summary to the employees. I know
Sure.
there's been some, misunderstandings about if you contribute to this 401k plan, then it's gonna mess you up with Social Security.
So the Social Security Administration, so as to make sure that there's not double dipping from their perspective, if any employee, which all employees of the county are technically eligible for a state pension, even if they're part-time, seasonal, et cetera, because they get the 7.5%, that qualifies as well. That makes them subject to the windfall elimination provision. And the windfall elimination provision is intended to make sure that they're not getting full Social Security benefits in the absence, or in the presence of a state retirement. So the way it works is that if employees have time in the Utah retirement system, it will discount the Social Security benefit they would have otherwise received. And I think it's an important issue back to the re-enrollment, because I think initially we had discussed this earlier in the year, and it was felt by the commissioners that it was maybe a little too paternalistic. But I'll contrast that with a phone call I got a few weeks ago from a participant who was part-time and said, I've been here 25, 30 years. And they claim no one really ever educated them on this windfall elimination, and now they're left with no Social Security benefit because they've spent their career at the county.
I sent that call to you.
Did you? Okay. But I think it's actually a good example of when you use those automatic features, is it better off in the end to be paternalistic, even though it may rub some the wrong way with the ability to opt out? Or are you better off just to let them with maybe more education figure this out? Here we have an example of an employee that maybe the county has documented that they've educated, but really didn't understand it. And so their idea of re-enrollment is, let's just assume that no one has time to think this through. Let's do what's in their best interest. If they want to opt out, they can. I think you're going to catch more with good intentions than you do by not using a feature like that. And, you know, speaking with this employee, I had to tell them the truth that, you know, that what you're being told is true. And they were very frustrated that they weren't educated, because had they had known, now in this case, they weren't eligible to get the 6.2% anyways, they weren't benefit eligible. But we know that there are 10 to 15% of full-time equivalent employees who are not getting that full 6.2%. So I think it's still best practice, and still, I think in larger scheme of things is the best thing to do. So we would definitely have you consider it as an initiative for 2018.
Well, and although this is a non-ERISA plan, you do follow pretty closely what parameters are on an ERISA plan. And from a Department of Labor standpoint, they look favorably on re-enrollment and asset allocation to tools like GoalMaker and contribution escalation, because they really want to help people in spite of themselves, right? Save for retirement. So they look favorably on all of these types of things to help people save for retirement, which we know, especially with the new tax laws coming out, we don't know how much we're gonna be able to save and how things are gonna change, so we really need to protect the futures of those people who have 30 years left to go. So I think it makes sense to put it on the next agenda.
Kelly, just one comment too. My understanding is when you get your annual statement from Social Security, if you do qualify for a benefit, that estimate of what you might get does not include that windfall elimination. So
I would believe that's correct.
That's
you get that statement, you might think you're getting that much, but it's going to be less, significantly less.
Yep, because they don't tie, the state and the federal don't tie together when they're sending out those benefits.
Right.
Yep.
That's a good point.
So just watching my time here, why don't we turn to page 90, no, not 96. We'll go to their plan for, I think it's 58. And we'll talk about the 457. We'll just briefly go over the growth and the assets inside of there. We have 525 total participants in the plan as of today. We've got 355 active participants, down both in active and total. And then we have 172 terminated participants, which is a little higher than the year before, which is 168. Average participant balance is about $63,000. The median is about $34,000. And then we have 341 of those people over the age of 50, and they're holding 27, almost 28 million of the $33 million in the plan. So that's a significant portion of the total amount of dollars in the plan. We had just a little more distributions year over year, from 1.9 million to 2.4 million. And then we're gonna go and flip to page 96 and just briefly talk about the demographics of the 401A, which is a frozen plan. It's no longer eligible to be to join. But we do have 2,065 people in. So do I have these backwards?
Yeah,
Because the A, you can't join anymore, and we didn't have any growth in that, so.
this is it, the 457
Yep.
one. That is the A.
So this one's the 457, please correct me on that. So this is the 457, we do have a little bit of growth. We have over 2,000 people participating with 1,000 active participants. We have 1,030 participants that are terminated. And then this multiple status, I just thought I'd bring that up for the committee to know. That just means that somebody has either terminated or changed statuses, gone from full-time to part-time, or whatever the status is for the requirements to be in this plan, within the quarter, so that it shows us that they had two different statuses within the quarter. The average balance for active participant is 16,000, and the median participant balance is not very high, about 158. We have participants over 50, 612, and they again are holding the bulk of the assets with about $15.7 million for those people 50 and older. We have employee contributions in this particular plan of about $1.1 million. We did have some money roll into the plan, just a little bit, about $1,100. And then we've had 1.5 million in distributions, which is just a little bit lower than the year before, of 1.8 million, with a balance in the plan of about almost $22 million. So the last thing I really wanted to talk about, and there's a lot more information in here, but again, I want to make sure I give everybody their time, is I wanted to bring up to the committee, and the employer has been notified. Now the employees are going to be notified as of 1/1/18. We're adding some participant-initiated account fees to the plan. Some, we already had the fees. Some, we are adding fees. And so what we mean by participant-initiated, it's those types of things that the participant decides to do. They decide to take a loan. They decide to have a distribution. They decide to leave their dollars here in the plan. We're adding those fees on an annual basis starting in 18. So the loan processing fee, we had that on the plan already. It was $50 per loan. It's going in January of 18. Sometime after January of 18, it will become $95. We'll also have a loan maintenance fee, which we didn't have before, which is $50. We have a distribution fee now of $50, and there wasn't one before. And the largest fee that's going to affect a participant is what we call a quadro. So basically what a quadro is a qualified domestic relations order. That is something that happens when you get a divorce, and they have to segregate assets and separate the assets between the husband and the wife. And what happens is that has to be done through the court system. The court system sends it to the employer. Utah County has outsourced that to Prudential. There's a lot of work, and because you have to, it's really called a DRO, a domestic relations order, and we're required to qualify it. And there's a checklist of things that we need to do. So we have put a fee on there of $750. Now, we haven't had a lot of quadros here at Utah County. And all of this will be explained in a letter to the participant shortly. I know we've got a little bit of work to do with the employer, making sure that we only send it to the people that we've got this quarter, we're not sending it to those people. So just to let you know why Prudential's doing this, this is something that most record keepers have been doing for a while, having these participant fees. And we have been in an environment of where we're very competitive in our pricing within other vendors. And so this is one way that we're gonna be able to just work with our participants and have some fees get paid, because it's very costly to send out a loan to, with no, distributions on a plan, you gotta send out the checks and you have to monitor everything and keep all the paperwork. So we've just decided that that's one place that we really needed to kind of tweak our fees a little bit.
Kelly, can you just talk about the distribution transaction fee again? Is it for every transaction, or is it and it doesn't matter how much the amount of the transaction is? Or
Well,
is it?
That was my question too.
So you have a loan processing fee, a loan maintenance fee, a distribution fee.
So the distribution,
Distribution
like let's say
fee.
someone took out 10 grand one year, or someone took out
Every
their
time
whole
they, every
balance.
time they take
So
a
every-
distribution.
So it's every time, and it doesn't matter the amount. If
Correct.
it's
So if
$1,000 or
someone-
If
$10,000,
we touch
it's
it,
the
we're gonna
same.
charge the fee.
So if they're taking out an annual maintenance, they're paying that every
Right.
time there's a distribution.
So are these fees, are they set forth in our current agreement with Prudential? I'm just wondering if it can be unilateral, or whether the county would have to modify their agreement with Prudential
I
in
don't
order to change
believe,
the fees.
we wouldn't have sent it out to be able to change these fees if there was something in our agreement that didn't allow us to do that. But I will go back and double check, but it's my understanding that we've scrubbed all the plans out that would have something contractually that says that in particular participant fees cannot change.
I think it would just speed it up for us if you could give us chapter and verse,
Okay, I certainly can do that.
part of the agreement.
Yep.
So if I retire and set up a monthly distribution out of the account to come into my home account, there's a $50 fee every month, every time you process a check for me? That sounds extreme.
Let's say you started out on like a required minimum distribution because you hit age 70 and you're going into that, and does that can it come out monthly, or does that come out quarterly, or
We do
annually?
a required minimum distribution annually.
Okay, so it's.
So we don't
there's
do
no choice.
monthly, we don't do monthly
All right,
payouts,
thank you, that's what I was.
so.
So to confirm, periodic payment distributions though are subject to the $50 each time, or is there a setup fee and a lower expense for periodic payments?
It says one-time fee, and that's why I'm wondering if it's just when you first set up a distribution account.
Right, so I will double check that, cause none of my other plans have, periodic, it's a lump sum, or, you just take it, there's no, but because you're a government entity, it might be a little different, so,
Take it and you have to roll it into an IRA.
right.
When these were published, it will say that our office compared them with market averages, and they're in line with market averages. That's one particular case where the competition would do a one-time setup fee that's in that range, and then a lower fee ongoing if there's a periodic payment cycle that's set up.
Yep.
So we wanna confirm on that.
I will confirm that. Any other questions?
So it sounds like Prudential's rolling these fees out across the board. It's not just Utah County, but most of your clients, unless there's an agreement that prevents it,
Correct,
it-
correct.
you're increasing the fees across the
It's,
board.
it's across the board. Mhm. Just the cost of doing business and these types of things that we've never charged for before. And again, we realized we were kind of lagging the industry in that, and it's, it's just one thing that as we all look at, you guys know you have budgets, we all look at things, and not everybody can take a loan, and I know that loans have been topics of conversations here at Utah County. I know with my other plans, they actually kind of like the higher loan fee because they're trying to hopefully keep you from taking loans. The better places to get your money than in your deferred.
And this may also play along the lines of transparency. you know, but trying to be more transparent and pay as you go for what the actual costs of having the account versus a revenue share probably is driving some of this as well, I would think.
I'm sure that with Prudential, definitely everybody going to that zero revenue share, you know, we would have these types of fees built in to how we are currently charging. Almost every plan we have is going to some kind of a net revenue of zero, and then, you know, charging either a per participant fee or an asset-based participant fee, whichever ones they go with. But then those fees are now getting overlooked, right, because we bring everything to zero. And so we're looking at adding these fees to be able to keep the plan fees as low as possible. Because why should all participants pay for a person who takes a loan or a person who takes a distribution? Those people that are taking those should pay for those.
I just think a distribution is part of cost
Well,
of doing business.
I agree with, you know, with what you stated there, that each participant ought to pay the expense that they cause the plan to incur, whatever that reasonable amount is.
Right.
That makes sense. So that one employee isn't subsidizing another employee.
Right, and would you agree that that whole fee-based, everything is just kind of going to more of that fee-based? Everything has a fee to it versus it bundled all into one product?
Yeah, and in addition, I think Prudential's the only firm that we know of that didn't have any fees for these things prior to 2018, so I'm actually shocked that it
Took us so long.
took me so long to introduce it. I mean, it's been great, I think, for the county and for those that have taken distributions, but it's probably a more equitable way to spread out the cost.
But I'll follow up with you on those distributions on PRF payments.
Thanks.
Any other questions?
What's the deadline that you need to know about our decision? Because it sounded like you needed it by this Friday. Can you confirm some of these questions before?
Yes, I can
So
confirm.
we can get you an answer? Because I'm assuming you're trying to get this out and effective as of the first of the year, right?
Yeah, it's going. So there's just a little bit of work that we need the HR department to do on the eligible but not yet enrolled in the plan. So those people will have to, because they're not enrolled yet, right? They're not getting auto enrolled till 1/1 because of the waiting period. So we want to make sure that they scrub against that so the letters don't go till after.
So do we need a motion on this
I don't
subject?
think so, because if the contract allows you to do it, it doesn't need our approval. If the contract prohibits it, then you don't need our approval because it required amendment to the contract.
And I'll just, like I said, I'll just make
I
them
think it's
double
just
check that,
advisory at this
like
point.
Cammy like to see the verbiage or if there is no verbiage, that's why we're able to do it, so.
And then also, if you find out the answer on that distribution fee, maybe some further discussion as it rolls out to the employees, because they're probably gonna have the same questions we're having here. You know, whether it's a one-time or whether it's, you know, per withdrawal, especially on a periodic
I
payment.
agree,
that
because
would
that's
be-
something I think
My
employees
guess
will
is,
really want to know.
and again, don't hold me to this, cause now I'm on tape, but, my guess is we don't charge every time someone takes a distribution. My guess would be like an annual charge.
It does say
So-
one-time fee, but
Yeah.
the question is, it one time for every withdrawal, or is it one time?
Cause that would be, I mean, if you think of people with small account balances too, it could eat it up
Right.
pretty quickly. So
Yeah,
my guess is that, but I'll just confirm.
okay.
Thank you.
Thanks, Kelly. For the employees that are here, I'm impressed. You have a lot of staying power. This is a really exciting topic, isn't it? So we're gonna change gears a little bit and talk about just some quick survey results for the employees and our worksite services. We'll have a quick market overview for those that are here for the first time. We'll give a quick introduction of the fiduciary investment review, why the employees benefit from it, and what its objective is. So with that, really quickly, the committee knows that we're here about 12 days a year currently, NFP is. Brant's would have been here to present his own results, but he's actually out in Vernal today doing meetings. Just want to share the feedback we received from participants. Our employee surveys and net promoter scores are both quantitative and qualitative. We give employees an opportunity post-meeting to share on a scale of 1 to 5 how valuable they felt his service was, or if it met expectations. The first question you can see here is please rate the overall experience with an advisor. Right now, the mean score is 4.17 out of 5, 3 being met expectations, 5 being exceeded expectations. Next question was, how valuable was the information you received? Continue to have high scores, about 4.5 on the average. I think you'll see similar results down below on how valuable is the one-on-one meeting, in 4.5 out of 5. So we're shooting for 3, got 4.5. I think the trend over the last few years is that, at least if we're using survey results as a benchmark, is that employees want advice. They want retirement planning, investment advice, and I think delivering it through the work site is a successful means for delivering that service. And so again, I think we continue to see that feedback be the case. Any questions on the survey results? I think it's very similar to what we saw last quarter.
How many years did this go?
We had about, 2 years worth of data, Jared, on the survey results? So when we send the most recent deck, it'll have 100% of the responses that we have in our system. Both the quantitative, and then we have a narrative portion where an employee gives advice to the county on what they liked, didn't like, or would like to see improved. I think it's valuable.
I don't know if you know this or not, but was there any change between the years as far as is it about the same from year to year, or are we improving or not improving, or do you have any feel for that?
Yeah, there were a couple that would have fallen off this computation period that, like typically the 1s and the 2s, if we look through, that they will be associated with a commentary, because the final question asked to provide commentary, and it would have been that the meeting went a little long, or the meeting prior went a little long, and so theirs started a little late, and they felt like they had condensed time, so they gave a poor score as a result. As we've enhanced it, I think it's eliminated or limited the majority of those situations where the experience is poor because it didn't start on time, or that they didn't get enough time, or whatever else might. So, but they're still about similar. I think the overall trend is upward. Experience has improved year over year.
One of the noticeable changes was going from 30 minutes to 45 minutes. I just felt like 30 minutes wasn't enough. If you remember, we try to gather as much as we can pre-meeting. But one of the trends we did notice, and we tried to adjust on, was that more employees wanted information on how what they do in this plan correlates with the Utah retirement system. How does the windfall elimination or government pension offset work? So I think there continued, maybe should be a focus on efforts to improve that education, because to Dave Shawcroft's point earlier, when an employee has worked in the private sector and they've earned a Social Security benefit, when they receive that statement, there's no reference to an offsetting with the state pension. So there needs to be ongoing education, because we have found that's continually, there's a lot of myth and legend about what it actually is. I've heard about 10 variations of that with employees here, but the reality is there is an offset, and there needs to be continued education, in our opinion, on that. Any questions on the survey results before we get into the market review? Okay, so for the benefit of those maybe employees who are participating or viewing what goes on in these meetings, this last section is what we call our fiduciary investment review. And the objective of our fiduciary investment review is to deliver a couple things. One, to give you some context on what's happening with the global economy. Why do we care about that? Because the investments that you invest in here at the county invest in traded securities, including equities, bonds, and other cash instruments. And so understanding a macro level view first gives us some context for what goes on in the individual asset classes. The second part of this, we'll go over a service plan update where we report back to the county on all the deliverables we've given over the past quarter and over the past year, and what's scheduled to be delivered in the future if applicable. The third part is an investment policy statement for the employees where this process is new. This committee has an investment policy statement that defines the process for how we go about adding, monitoring, and reviewing investment choices, and where appropriate, removing investment choices. With over 20,000 registered investment products, there's a lot of investment choices for the county to choose from. I think it's important employees know the county has a very rigorous due diligence process. NFP, as a contracted service provider, fulfills a legal responsibility, and that we're a fiduciary advisor to the committee and its plan. Then I'll have Jared will come up and deliver the actual results. And with that, I just want to give a quick update in the market. And I've kind of prepared just a quick summary verbally that I'll read to the committee that I think will give us a good summary of this quarter. So, in spite of heightened geopolitical uncertainty, and as you're aware, multiple hurricanes, both that have hit the U.S. and other countries near the U.S. and the Caribbean, the equity markets have marched to new highs in this quarter. And specifically here in the U.S., we saw a 4.6% positive return by using the Russell 3000 index, which is a proxy for the U.S. equity markets. And that was bolstered by a increase in earnings of corporate America. We've seen an earnings return, and we've also seen continued low interest rates and inflation. And as you're probably well aware, there's a tax reform proposal right now from the White House that came out in late quarter. It mirrors a lot of the provisions of the House Ways and Means proposal, and there is anticipation that that tax reform will lead to positive U.S. economic growth. And if you understand equities and the trading of equities, many times it's the anticipation of the growth that comes from tax reform that gets investors excited. So while we've not seen the effect and nothing's been passed yet, investors sometimes will purchase in an effort to anticipate the positive impact of those tax reform changes. Internationally, while the U.S. has been at 4.6% positive return, we saw better results internationally in the equity markets. International equity markets returned a positive 5.5% over the past quarter. So also a great asset class. And after briefly dipping down near 2% intra-quarter, the 10-year Treasury finished the quarter relatively unchanged at 2.3%. And the broad U.S. fixed income market posted an 80 basis point gain for the quarter. So with that, we'll go into a couple slides here on some specifics. And maybe just Jared start with earnings, and we'll maybe just talk about that only. Just go up to an earnings slide. So if we kind of point to what's driving capital appreciation in the equity markets, I would probably just use this one slide that shows that there's been a return to earnings. And so while the overall economy has slowed and is projected to slow in the next few decades compared to what we've seen in the last century, corporate America has been more profitable for a couple of reasons. There's been a repatriation of international earnings with where in the past we've had a negative currency drag or headwind. That's been a positive as we've had the dollar not be so strong. And maybe another sector that has had a big impact on an earnings recovery is the energy sector. You started to see that anecdotally with gas prices going back up, and a lot of these oil and gas companies are still producing, but we're starting and projecting to see a recovery in the energy sector. So again, we mentioned about a year ago that the energy sector in and of itself made up about 1/5 of the U.S. economy. If you looked at all the service providers to it and those that actually produce in that area. So when there is a reverse currency boost, and we have increase in commodity prices in the energy sector, it has a direct boost to the bottom line or earnings. So that continued earnings boost will continue to be a tailwind in the equity market return. So it's been a real positive. So it's been a great year. This kind of shows you in the last year what happens when you have a different election outcome than you anticipate. Just a couple quick regulatory and legislative updates. We believed a quarter ago that we would see some reform to retirement plans. And one of the good things that has come out of this tax reform is that 401k plans, 457B, government deferred saving plans, and 403B plans have been untouched. So there's been no significant change. There was a thought that the Congress might Rothify the 401k plan. That did not happen. So as of right now, we have no changes to the 401k plan. So there's a commitment, bipartisan commitment, that regardless of your belief on tax reform, that we should not remove some of the incentives that exist today to incentivize employees to save. Those incentives being tax-deferred growth and tax deductions on contributions. However, there were a few changes for next year that are notable. Employees will have the ability to save $18,500 next year, which is a $500 increase from the current deferral limitation. Additionally, may not be as applicable in government, compensation limits have been increased. And when it comes to using compensation for testing purposes and matching purposes, and the annual addition limit, which would be inclusive of deferrals and non-elective contributions, has gone up $1,000 to $55,000. There are some defined benefit changes, but again, because you're a non-ERISA plan, you're not subject to these changes, even though the state of Utah may decide to actually do them as a best practice, but more focused on managing their own risk pool in the state of Utah. Any questions on the couple of these increase and deferral limits for next year?
Not on that, but maybe on the economic analysis. Obviously, the stock market has been in growth mode for a long, long time. And, you know, there's people that are starting to get worried that, you know, how long can it last? And you know, what I'm hearing today is things still looking pretty rosy. And it sounds like we're anticipating, you know, more of the same going forward. Do you see anything out there that worries you, or any asset bubbles maybe forming, or any cautionary that you might give us?
Wow.
I know it's a loaded question,
yeah, we don't have
and
a whole
nobody
lot of
has a
time.
crystal
So-
ball, but
So I'll use this slide, Kim, to reinforce a point, is that what you're referencing is that there are certain valuation measurements we use to get an idea of a benchmark of if prices are below, at, or above market averages. And I think this slide here is important because on the bottom right, it shows us a couple different indexes we can point to using the forward price earnings ratio, which is one common valuation measure that's used. It looks at the price of stocks relative to earnings. And the multiple that has, you know, a number with an X behind it tells you how many times the annual earnings are investors willing to pay to hold that stock. What's the current valuation using this measure? To answer your question directly, if we use this valuation as one view, it would actually indicate that the U.S. market is overvalued at the moment. Developed markets are right about historic averages. We look at geographic specific areas. Europe is fairly priced, but has opportunities because there's still there's some economic maneuvering going on with the federal governments in Europe, and the same in Japan. So what I'd say is, while valuations are higher than historic averages, there continues to be momentum because we've seen a lot of this valuation increase in just the earnings. So we're not seeing maybe the growth we've seen, but we've seen companies be more profitable, which is driving the valuation because earnings is used in this measure to actually calculate the valuation statistic. So are we above historic valuations? Yes. Is there reason to be concerned if you believe in long-term statistics? Maybe. Maybe yes. But I think there's the challenge that investors have today is that we just talked about, you know, the 10-year treasury is 2%, and the bond market doesn't do well in a rising rate environment. Yields, because of those low treasuries, are similar. You cannot realize much yield in a savings account or even the guaranteed account here. The fixed account with Prudential, of course, is higher than what you could buy on the street in an FDIC insured account, but it's still low. So while those asset classes have their place in modern portfolio theory, if you're looking at valuations alone, it does appear high, but there's not a lot of other choices. So you look at capital market assumptions we have going forward, they are tempered. So there's an amount people use usually when they describe this index, the S&P 500. You'll hear historically a lot of economists believe, and the results show that's returned around 8 to 9% per year over the last 50 years. Well, the capital market assumptions would have that be much less. And so while our economy is slowing down, et cetera, if you look at current valuations, I expect the return would be lower than that. In the meantime, all the gains you have in your plan are unrealized anyway to actually sell positions. And so this is just kind of part of the ups and downs. We do think those that create our intellectual capital believe that the landing, when we do have a business cycle, will be maybe a little softer this time because the expansion was slower. This is the third longest expansion in U.S. history. We're 9 years into it. Prior expansions and contractions were much more steep in both the jumps and the decreases. So I think we're seeing maybe with the more mature economy in the U.S., those spikes be flattened out. Internationally, in emerging markets, because they're not as developed, we'll maybe continue to see more spikes, just simply because they're more volatile. So yeah, valuations are high, but again, I think long term, since that's the horizon in these retirement plans, equities still play an important role, and it's almost impossible to time the market. Now, if we were 2 standard deviations away, like we were back in 2007 on valuations, maybe you get nervous, but I don't think we're there yet. 2001? Yes, that's what I said, 2007. They were high in 7 too, but they were yeah, twice that in 2001. Okay, with that, any questions on macro level economy? Now we want to drill down, just finish up with the service plan and the scorecard. Okay.
So for those who are here for the first time, this is the part of the meeting where the committee usually has to splash their face with water. If you thought it was boring up until this point, hold your opinion until after this part. What you're looking at here is our fiduciary service plan update. So we report to the committee each time we meet, what we've accomplished and when. As you can see, over the last couple of years, we've met quarterly, and those are the dates that you're looking at where we met. And also our worksite consulting advisory services delivered throughout the year. If you look down under employee communication and education, the various dates that Brant and his team were on site performing those education meetings. Each quarter also we look at the investment policy statement. So Jeff brought this up in the beginning. The investment policy statement is what we use as a committee that helps us define how we add, monitor, and delete investments from the lineup, provides a process for the committee with definable triggers that would determine when a fund is failing a minimum level of due diligence that's been adopted by the committee. Built into the investment policy statement is the scorecard methodology. This is our proprietary scorecard methodology that scores all of your investment options from 0 to 10, 10 being the best, 0 being the worst, and in accordance with the IPS, a fund scoring a 7 or better is considered acceptable or good. It's not removed or replaced. A fund scoring a 5 or a 6 is placed on a watch list, where it will remain for 4 consecutive quarters before being recommended for removal, or 5 out of a trailing 8 quarters before recommended for removal. A fund scoring a 0 to 4 is considered poor, and in this meeting, a vote is made to replace it with a manager that has been vetted out. This shows the scorecard methodology. There are 3 types of investment options on your plan: asset allocation funds, like the target date funds, index funds or passively managed investment options, like the index funds, and then actively managed options, which most of them are scored based on this 10-point criteria. It's both quantitative and qualitative in nature. 80% of the score is quantitative, 20% is qualitative, as per recommendation by the IRS and the Department of Labor and best practice. The committee is already familiar with the scorecard methodology. The quantitative piece is based on a pass-fail criteria, which we'll see when we get to the scorecard itself. The qualitative piece is based on the people, process, and philosophy of the investment managers, fund manager tenure, underlying expense ratio of the investments, so on and so forth. What you're looking at here is the actual scorecard for the quarter of the investment options on your plan and plans. On the left, you'll have the actual named investment manager and the asset class category in which they fall in. So the first, we look at the target date funds or the asset allocation funds on the plan. They range in their risk-based model portfolios that range from moderate, conservative to aggressive in nature. And as we lump them into categories versus benchmarks and peer groups, they fall in line that way. The next column that you'll see are the assets in that investment option as of the close of the market when it was prepared at the end of the quarter. The ticker symbol for each individual investment option. And then each individual score criteria. So the first 30% of the score are based on style characteristics. The next 30% are based on risk-return characteristics relative to a benchmark. The next 20% or 2 points of the score are relative to the peer group on an absolute return basis and a risk-adjusted basis. And then the qualitative component. And then in the end, the column in blue is the score for this quarter. And the next 3 columns are the prior 3 quarters. Any questions on that at all? So your target date funds continue to score well or within range to be considered acceptable or good. The target date fund managers we hire and fire as a fund family. So you'll notice that individual investment vintages or tiers, so the 2010 option, for example, which scores a 7, is not as strong as the 8s or the 9s that you see in other vintages. Mind you that the top number that we look at, the aggregate score amongst the target date fund managers, is what we look at to determine whether or not, according to the IPS, they should be removed or replaced because they're hired and fired as a family. In other words, we wouldn't replace the T. Rowe Price 2010 fund with the Vanguard 2010 fund and leave the other T. Rowe Price options on there because they're a uniform glide path that were associated with those. Next, we look at your U.S. equities from large cap, mid, and small, value, blend, and growth. This is the first area where you'll actually notice there are some funds that are scoring within that watch list category or criteria. And one fund this quarter actually recommended for removal, as it's been on the watch list now for 4 consecutive quarters. So on the left, again, your large value, large blend, large growth, mid, value, blend, growth, and then your international equity, the assets associated with those, and then in the blue column, 10, 9, 10. Jeff, you opened up full screen, so my eyes aren't good enough to see those. But the first one you'll see, Barron Partners Institutional. It's at a 6 right now on a watch list. It was on the watch list last quarter in spite of being a 7, because if you look 2 quarters ago, it was actually a 6. and we're looking at 5 out of a trailing 8. It did improve over the last 2 quarters, but it's fallen back down into watch list status, still in the top half of its peers in an absolute return basis and nearing the top quartile of the peer group on a risk-adjusted basis. The next one down, JP Morgan Small Cap Value, third consecutive quarter on a watch list. So it's gone from a 6 to a 6 and then to a 5 in the coming quarter, failing 3 out of all 3 benchmark statistics, and barely failing on its peer group rankings. If you recall, a fund has to score within the top half of their peer group on an absolute return basis and a risk-adjusted return basis. So that number there, 52, means that it's in the 52nd percentile of its peers. That has to be below 50. So it's barely failing on an absolute return basis, and on a risk-adjusted basis, also missed by about 5 percentage points, scoring at the 55th percentile. And then the last one there, the small cap growth, ClearBridge Small Cap Growth. This is the 4th consecutive quarter on a watch list, and therefore should be recommended for removal and in accordance with the investment policy statement. And as soon as we're done looking at this, I'll show you the recommended replacement that we've been reviewing as a committee and monitoring as we've gone through this process. Janus, or your core bond, still performing well, and the passive strategies, large cap blend, mid cap blend, small cap blend, all scoring acceptable or better. So in conclusion, prior to the recommendation, we have 2 funds on a watch list, 1 fund recommended for immediate removal to be voted on today.
Can you go back 1 slide? I want to see how much money have we got in,
ClearBridge, about 5 million as of the end of the
and
quarter.
JP Morgan, there's just 2.5, so not a lot, but still enough.
And I'm glad you brought that up, Kim, because 5 million is an important benchmark in this space. So with small cap growth funds, it's difficult to find an investment manager that is open, that's still continuing to take new assets. And the reason for that is, if you think about it, they're investing in small companies domiciled in the United States whose market capitalization is kind of in the 3 million or smaller range market cap companies. And if any given mutual fund or investment option has a huge pool of assets they're using to invest, they could gobble up the entire issues of a small company and have minimal impact on their portfolio. And so typically small cap mutual funds will close after they've hit a certain number of assets to invest in. And so the options available to us to choose from are fairly limited in and of itself. And 5 million, and then also when you're looking at pricing into an institutionally priced mutual fund or an asset class category with 0 revenue, they may have minimum requirements. 5 million is typically that minimum requirement for some of the asset managers that we've utilized in that space in the past. It is a sleeve inside Goalmaker, and so half of your assets are in Goalmaker, or half of your participants are there. So this would impact the portfolio, the makeup of the portfolio within Goalmaker. Now, it's always recommended that it goes to another small cap growth fund, so the makeup of the portfolio isn't changed other than the name of the underlying manager in that sleeve.
So just to be clear then, these balances would include the sliver that's coming out of Goalmaker?
Yeah.
Of all the employees?
That's actually the aggregate balance across all 3 plans, in and out of Goalmaker.
Okay.
But for instance, JP Morgan Small Cap Value has, just in the 401k plan alone, 700 participants. So I'm just saying it will affect, and then the fund change notices going out to those affected within Goalmaker, or if they're investing that on their own.
Yeah.
I think it's worth noting, anytime there's a fund change recommendation voted on by this committee, there's a period of time that required by law to inform participants. There needs to be a 30-day notice requirement prior to that trade taking place, and so anything voted on by this committee typically has about a 60-day, roughly 60-day turnaround time before the change is actually implemented. We try to compress that as much as possible, but there's scheduling the trade, creating the notices, sending out the notices, and then waiting the requisite time before that trade can take place.
Jared, do you have a recommendation then for the one that
Jeff,
we're going to replace? And do you have maybe 3 years, 2 or 3 years of back data on where they stand that we can kind of review?
Yes, so all of the scores, for the sake of the committee and those that are here for the first time, are evaluated based on a 5-year computation period with a 36-month rolling window within that period. So we're using rolling returns inside of a 5-year computation period to evaluate them relative to their peer group and their benchmarks. At the top, this is a summary of considerations. We have 2 funds on a watch list, and then down below, the comparison side by side between ClearBridge Small Cap Growth and the recommended replacement Fidelity Advisor Small Cap Growth. What you're looking at here is the recommendation to the Z share class of Fidelity Advisor, which is the zero revenue share class. In the event that we move to a zero revenue based fund lineup in the future, it would be this. In the notes, you'll notice there's the institutional share class that does have commensurate revenue sharing with the existing lineup. That would still be recommended as the replacement candidate. But we're looking, if we look at it, it's going from a 5 on ClearBridge in the blue to a 10 on Fidelity Advisor Small Cap Growth. Fidelity's passes all of its style characteristics, its risk return relative to the benchmark, and its absolute return, risk-adjusted return in the peer group. The 5 there in the risk return peer group column means that they're in the top 5th percentile of their peer group. On a risk-adjusted basis, top 2 percentile, so they outperform on a risk-adjusted basis over the computation period. 98% of the investable, of all of the small cap growth mutual funds in the market, whether they're open or closed.
So is this a relatively new fund since you only had 3/4 showing there?
Yeah, so this fund, old enough to have a score, so 3/4 ago it would have turned 5 years old, allowing us to
Okay.
provide a score on that, and for the consecutive quarters following. Now, the manager, the named portfolio manager, Fidelity is not new to the small cap growth space. As I mentioned before, bumping up against some of those investment constraints requires options to be closed, and larger managers like Fidelity have the capacity to open additional funds or new funds that with the same investment objective. In conclusion, the summary of consideration to be voted on by the committee, we propose that ClearBridge small cap growth be eliminated and assets in that option be mapped automatically to Fidelity Advisor small cap growth when that trade can be completed. Any questions or any additional information needed prior to making a vote?
I assume if an employee wants to opt out of the new investment, they can so declare and specify where they want it to go versus automatically mapped?
Absolutely. So if a participant does nothing, they will be automatically mapped to the new investment option. If they don't like the Fidelity Advisor Small Cap Growth Z fund, they have the opportunity to move their assets into any option or just move them out of ClearBridge Small Cap Growth today, and they wouldn't map any assets into the Fidelity Advisor Small Cap Growth. Now, if they're within
So that-
Goalmaker,
They just need to move it before the 60-day
Right,
period,
it's 60
sometime
days.
before the 60-day period.
And Goalmaker obviously would be pretty automatic as a replacement, which is fine, just so everybody understands.
and all of your investment options are also no load, no transaction mutual funds, so that they can be traded or changed out at any time without incurring any transaction fees.
So I had a question there. You make the recommendation, it says here, provided the rest of the zero revenue lineup is accepted. So
Yeah.
if we're still in the process of doing that, because it hasn't happened yet, even though that's the way we want to move, would you recommend that we make that change now with regard to this, to Fidelity, small cap growth?
Yes, so the FCIGX, the institutional share class,
Yes.
it should be considered if you're going to make this change by itself without the institutional pricing that we looked at in the prior 2 quarters. It would be, instead of FIDGX, it'd be FCIGX, which is the institutional share class, which revenue shares
Yeah.
25 basis points commensurate with how pricing is on your plan today.
So we're not changing those others to the zero revenue class today, but we hope to do so in the near future. So you would suggest that we make the change here to the FIDGX? Just because we're planning to do that in the future, or that we not until we do it all as a
I would
group?
do it all at once. So if you're not gonna do everything now, instead of doing the FIDGX, it'd be the FCIGX is the recommendation, to move to the share class that is commensurate with the
Yeah,
share classes
that's what I
existing in the plan.
Talk a little bit about what it would mean to move everything. I mean, what does that mean to everybody if we went to the
Zero revenue.
zero revenue?
So right now, all of the fees associated with investing in the 401k plan or the 457 plan are paid through a process called revenue sharing. So individual participants in the plan or investors pay an expense ratio of the given mutual funds. And of that expense ratio, any given manager may need only a portion of it to pay for the cost of investing those assets in the market. So Fidelity, for example, or ClearBridge of the 90 basis points that you pay them, they may only need 70 basis points to manage the money. The other 20 basis points is sent back to Prudential in the form of revenue sharing that's used to offset the costs associated with the record keeping of the plan. The way it would work under a zero revenue environment is that all of the mutual funds would be, the expense ratios of the mutual funds would be the zero revenue share class, the share class that does not provide any revenue sharing back to the record keeper to offset fees, forcing the record keeper to put either an asset-based fee or a fixed dollar fee across all the participant population.
So let me just interrupt. So if we did that, we would have to obviously communicate to the employees that we're moving from this fund to this fund to accommodate that revenue share, zero revenue share.
Right. And
So it would take another 60 days in order to roll all that out.
yeah, or perhaps longer. When you're
Typically.
investing, yeah, when you're making fund changes across the entire menu, it typically takes a little longer.
Would it, about
Well,
what?
and then we also, from a standpoint of changing the way we're assessing fees to the participant, we only do it on quarter. So we need to keep that in mind as well. So if we make the decision first quarter, it wouldn't be done till June 1st, because we wouldn't be able to get it all done and assessed by April 1st. It does take longer than 90 days to get everything in place, all the communication. I mean, there'll be a fund package, this, that, the fund back sheets.
Too late for first quarter next year?
Oh, yeah.
What are we waiting on as far as this committee to make that decision? Are we still gathering info?
Still waiting, yeah.
Okay.
So I would make a motion, if we're ready for that. I would move that we recommend to the Board of County Commissioners that the ClearBridge small cap growth be eliminated and that it be mapped to the Fidelity small cap growth FCIGX.
Second.
Which does contain the revenue sharing of 0.25%.
I'll second.
Got a motion and a second, as Dave stated. I won't restate all of it, but can I, all those in favor say aye.
Aye.
That passes unanimously.
So we'll work with Prudential in order to get that paperwork signature ready and
And then
schedule
we'll
the
get it
trades
added to
and
the agenda.
employee education.
And so, help me understand that now everything goes through the commissioners, correct?
So we're a recommending board, so we'll recommend it to the commissioners and then they'll make the decision in a public meeting.
Okay, so then Tammy, because we have you though as the authorized signer, we'll need direction from you once they approve.
Okay.
Okay, so just a quick recap of the discussion and action items. We have the fund mapping recommendation that there was just a motion on. Besides that, all the other items were postponed for further discussion in the next meeting. Have I missed any action items besides the fund change recommendation that you're taking to the
Let's
board?
get us the meeting minutes for the last, for this one and then the one.
Yeah, we'll send over the meeting minutes. Yeah, we'll get those emailed over. Well, good. Well, hey, on behalf of NFP, I just want to thank the committee for the past 7 or 8 years. This will be our last meeting with you, and on behalf of NFP, I want to thank you for your business. And it's been a pleasure to work with all of you, honestly. And we've loved working with your employees as well. And just want to thank you for your diligence on behalf of the county's employees, and really have appreciated just your focus on doing what's right for them. And we, just being in the business we're in, we're very appreciative of you, because in the end, that really leads to good outcomes for the participants. So thank you for your business, and good luck in the future. Thank you.
Yeah, thank you.
Yeah, thank
Just-
you.
Yeah, I'd like to express my thanks too. And it's been a real treat to work with you the
Thank you,
last
Dave.
few years. Also, just a little bookkeeping item. I think all the documents, the minutes, everything you keep in our toolbox or something, whatever you call it.
Yeah, the fiduciary
Fiduciary
briefcase.
Yeah. Can you be sure that we get a full copy of all of that so that we
Sure.
can maintain those?
I think what we can do is probably just give you access to it, and if you want to go extract whatever you need, we usually keep it open even after you've termed the contract, and so we'll give you hopefully plenty of time to go gather what you need. Alternatively, I guess we could also just download, might be easier to download the files and just, if it'd be easier for you, less work, we could just give you a drive that has
That would be great. if you could
last
do
5,
that.
6
That'd be
years,
great.
everything, if it, see it of value. Would you prefer that?
Yeah.
Okay, so we'll add that to the action items in the meeting minutes.
Thanks.
Happy to do that. Okay,
Okay,
thank you.
With that, we'll adjourn our meeting.
Motion adjourned.
Second?
All those in favor say aye.
Aye.
We're unanimously in favor of ending.